Looking at the latest news and a stock chart that's just been on an absolute roller coaster, we have to ask, is this stock catching a massive relief rally on its way to being a strong buy, or are retail investors walking blindly into an overvalued trap?
It's really the ultimate question for anyone watching the markets today. I mean, we are looking at this bizarre collision of massive regulatory shifts, extreme technical volatility, and incredibly conflicting signals from the very people running the company.
Yeah, exactly. So let's set the stage. The subject of today's deep dive is Robinhood Markets Inc., ticker symbol HOOD.
Right.
And as of today, Friday, April 17th, 2026, the stock is trading right at $88 flat.
Yep. 88 even.
And our mission here is to unpack the, well, violently mixed signals in our sources. On one hand, you have massive regulatory tailwinds and explosive revenue, but on the other hand, you have heavy insider selling and some deeply concerning technical resistance.
It's a real tug of war.
It is. We need to figure out what is really happening under the hood of this retail trading giant. But real quick, before we get into it, please take a second to like this video and subscribe to our YouTube channel. And we really need you to leave your comments and feedback down below. It's essentially compulsory for the algorithms. It really helps the show out.
Definitely let us know what you think.
And as always, just a reminder that today's debate is purely for educational purposes. We are just analyzing the data, so absolutely no financial advice is being given here.
None at all.
Okay, let's unpack this. So to understand the stock's behavior today, it's currently seeing a slight bullish bump, up about 0.78%. We really have to look at the spark that ignited this recent relief rally, right?
Yeah, you can't separate Robinhood's current momentum from the seismic shift that just happened at the regulatory level.
Right, the SEC. They completely wiped out the $25,000 minimum equity requirement for pattern day traders.
They did. And honestly, the magnitude of this cannot be overstated. If you look at the history of that rule, the SEC actually implemented it way back in 2001.
Right after the dot-com crash.
Exactly. It's fundamentally this paternalistic safeguard.
Yeah.
The logic was that day trading is inherently risky, right? So you shouldn't be allowed to execute more than 3-day trades in a 5-day period unless you had a minimum of $25,000 in your margin account.
Which is a huge barrier for most people.
Huge. They just wanted to ensure traders had enough of a capital cushion to absorb violent intraday losses.
But the criticism of that rule has, well, it's always been that it protects the wealthy while boxing out everyday retail traders from managing their own risk.
Yeah, absolutely.
I mean, if the market is tanking on a Thursday and you've already used your 3-day trades, you were legally blocked from closing a losing position until the next day. You just had to sit there and take the loss. Removing this is just a total paradigm shift.
It entirely alters the market microstructure. By stripping away that 25K barrier, the SEC just unlocked millions of retail accounts to trade with basically unlimited frequency.
It's like taking the restrictor plates off race cars.
That's exactly what it is.
Yeah.
And when you increase the velocity of trading, you directly feed Robinhood's core engine.
So let's look at how that is already showing up in their financials, because the fundamental momentum here is staggering.
The numbers are massive.
Yeah, looking at their full year 2025 and Q1 2026 data, total net revenue hit $4.5 billion.
Which is a 52% increase year over year.
52%, and net income jumped to $1.9 billion. That brings diluted earnings per share to $2.05.
Right.
Plus, they are sitting on $4.3 billion in cash and cash equivalents, and total platform assets, up 68% year over year, sitting at $324 billion.
Yeah, those headline numbers are impressive, and what's fascinating here is the metric that actually tells the story of this SEC rule change is the margin book.
Oh, absolutely.
Robinhood's margin book exploded by 121% year over year to a record $18.4 billion.
Which makes perfect sense when you think about the mechanics of the new rule. I mean, if you no longer need $25,000 to actively day trade, but you still want to make meaningful profits on really small intraday price movements.
You need leverage.
Right, you need leverage. Traders are flooding into margin to amplify their buying power, and Robinhood is happily sitting there collecting the interest on that $18.4 billion.
And how effectively that leverage trickles down to the bottom line is just wild. That surge in margin utilization drove their Q4 2025 adjusted EBITDA up 24% year over year to $761 million.
Wow.
Yeah. When the cost of capital is stable, an expanding margin book is essentially just printing high margin revenue.
Okay, so they are printing money on margin interest. Their top line is growing by 52%, and they have this massive regulatory tailwind. But that fundamental success isn't really matching up with the actual price action on the floor.
No, it's not.
If we look at the chart, it looks like a completely different company. It's a massive battleground.
It really is. The 52-week range alone paints a picture of brutal whiplash. In the past year, the stock bottomed out at $39.21 and peaked at $153.86.
And now it's just resting right in the middle at 88.
Right.
Though if we look at the short-term indicators, they are technically flashing a strong buy.
Sure.
The 14-day RSI is sitting at 69.15. The MACD is at 3.17, showing a positive trend crossover. And the current price is sitting above both the 5-day moving average at 86.65 and the 50-day at 76.12.
The algorithms are just reading pure momentum from the SEC news right now. Momentum traders look at that MACD crossover and a high 60s RSI, and they see a trend that still has legs to run before it exhausts itself.
Wait, I'm struggling to buy that, though. An RSI of 69.15 is literally bordering on overbought.
Yeah, it's running hot.
And if we look at the overhead resistance, the 100-day moving average is acting as a massive ceiling at 89.46. And just above that is the 200-day exponential moving average at $93.
Yep.
Buying at 88 when the RSI is that hot, right as it slams into two major resistance levels? I mean, that sounds like a textbook bull trap, not a momentum buy. Are these algorithms just blindly reacting to the news?
Well, that is the exact friction playing out in the order books today. You are pinpointing the thesis of the technical bears here. They view this as a localized, news-driven pump that is just going to get violently rejected at that 89 to 93 zone. Because if we zoom out to the macroeconomic trend, the stock is still fundamentally trapped below its standard 200-day moving average.
Which sits way up at $107.39.
Precisely. And until Hood breaks and holds above 107, any rally is technically just a retracement within a broader downtrend. And the floor below us is a long way down.
Yeah, there is a major psychological support level at $70 flat. If that 89 resistance holds and rejects the price, traders are going to target that $70 level for the next leg down.
Exactly.
So if the charts are showing this massive tug of war right at the 89 line, we need to look at what the smart money and the underlying valuation models are doing. And honestly, the analyst models are completely fractured.
They're all over the place.
Simply, Walls models claim Robinhood is currently 55.4% undervalued.
Well, we have to look at the methodology there, right? Simply, Walson relies heavily on intrinsic discounted cash flow models.
The DCF models.
Right. A DCF model projects the future cash the business is going to generate and discounts it back to today's value. Because Robinhood's margin book is expanding so aggressively and their top-line revenue just jumped 52%, the DCF model projects that compounding growth into the future.
So it concludes the current $88 price is a massive discount.
Exactly.
But then you look at Investing Pro, and they just throw a bucket of cold water on that entire idea. Their models warn that HID is a classic value trap, claiming it is 31% overvalued, with a true fair value closer to $49.48.
Quite the difference.
Why is there an 80% divergence between these two platforms?
Because Investing Pro relies more on relative valuation multiples. They are looking at Robinhood's price-to-earnings ratios, their price-to-book, and comparing them against the broader financial sector.
Oh, I see.
From a traditional banking or brokerage multiple perspective, Robinhood looks incredibly expensive. The DCF model assumes Robinhood is a tech company that will continue to hyperscale. The multiples model assumes it's a brokerage that will eventually revert to industry-standard margins.
And the broader Wall Street analysts are caught right in the middle of that identity crisis.
They really are.
The consensus from 25 major analysts is a moderate buy, 18 buys, 5 holds, and 2 sells. But the price targets are just a shotgun spread. JP Morgan has them pegged way down at $47, while Citizens JMP is modeling a massive high of $155.
It's a huge range.
The average settles around 108, which ironically is right at that 200-day moving average we just talked about.
The institutional models are guessing at this point, which is why we have to look at what the people inside the building are actually doing.
The insiders.
Yeah. And this provides perhaps the most alarming negative signal for retail traders looking to buy this breakout. We are tracking massive, sustained insider selling. Over the last 3 months, Robinhood executives have dumped approximately $56.1 million worth of shares.
56 million.
Yes, and it's coming from the absolute top of the food chain. CEO Vlad Tenev sold $26.18 million worth of shares just days ago, on April 6, 2026. The CFO, Shiv Verma, sold over $400,000 worth of stock in mid-March.
Okay, here's where it gets really interesting. It's like the chef raving about how good the special is, but you catch him sneaking out the back door with a pizza box.
That's a great way to put it.
Right, because if the Simply Wall Saint model is right and the stock is genuinely 55% undervalued, and you are the CEO looking at a 121% expansion in your margin book, why are you dumping $26 million of your own equity right at the specific $88 resistance line?
It is the multi-million-dollar question. Now, to be fair, we have to add context. Executives frequently sell shares under prearranged Rule 10b5-1 trading plans.
Right, the scheduled sales.
Exactly. These plans are set up months in advance to sell automatically at certain prices or dates, specifically to avoid accusations of insider trading. So it's not always just a panic dump.
I hear that, but even if it's a 10b5-1 plan, the executives still set the parameters of those plans, right? They chose to trigger sales at these specific price levels. It suggests that internally, they might view the $80 to $90 range as a local peak, or at least a price they're very comfortable exiting at.
The optics are undeniably brutal no matter how you slice it. And the options market is aggressively pricing in that skepticism too. If we look at the options order flow, market makers are dealing with heavy put buying concentrated down at the $80 to $84 levels.
So institutional traders are buying puts, essentially betting that if the stock fails to crack that $89 moving average, the downside momentum is going to accelerate rapidly back into the low 80s.
Yeah, and those put levels actually act as a short-term floor because of how market makers delta hedge those positions. But the overarching point here is that there is serious capital betting against this rally maintaining its strength.
So to reconcile these two completely conflicting realities, this booming fundamental growth versus a bearish chart and executives cashing out, we really need to lay out the structural arguments.
Like you.
Let's start with the bulls. What is the fundamental case that this thing shakes off the sellers and actually heads back to that $155 target?
Well, the bull case is built on 3 major catalysts. First, the ongoing realization of that SEC tailwind. The removal of the pattern day trader rule isn't just a one-time bump, It structurally increases the daily volume and velocity of trades on the platform permanently.
Okay, that's one.
Second, Robinhood is successfully diversifying away from just being an equity and crypto broker. They are seeing explosive adoption of their new event contracts.
Let's unpack the event contracts for a second, because this is a massive shift in their business model. Instead of buying a stock and waiting for it to go up, event contracts allow users to essentially trade binary options on the outcome of specific events, right?
Exactly.
Like, will the Fed cut rates by 25 basis points? Will a specific candidate win an election? Will a company beat earnings?
It completely gamifies the news cycle. And from a revenue perspective, it's brilliant. Event contracts require very little capital from the user, but the velocity of those trades is incredibly high.
And Robinhood collects fees on that constant churn.
Precisely. Combine that with the rollout of their Gold Card, which is explicitly designed to trap users in their premium subscription ecosystem, and you have a heavily diversified revenue stream.
And what about the macro environment? The bulls are heavily banking on the Federal Reserve, aren't they?
Absolutely. The third bullish pillar relies on potential Fed rate cuts heading deeper into 2026.
How does that help them?
Well, if the Fed cuts the federal funds rate, Robinhood's cost of borrowing goes down. If they maintain the interest rate they charge their users on margin, their spread widens. That makes that $18.4 billion margin book exponentially more profitable without them having to lift a finger.
Okay, wider spreads, sticky subscription revenue, and higher trade velocity. That is a potent mix. But what is the bear case? What breaks this thesis and sends it tumbling back down to the 40s?
The bear case looks at the forward guidance and sees a wall rapidly approaching. Analysts recently revised their 2026 overall revenue estimates for Robinhood downwards. They pulled the target from $5.6 billion down to $5.3 billion.
Wait, if they just remove the day trading limits, why is Wall Street revising revenue estimates down?
Because of customer acquisition costs and market saturation. The bears argue that everyone who wants a Robinhood account already has one.
Ah, I see.
Yeah, the platform is relying on squeezing more revenue out of existing users rather than capturing new ones. But really, the far more dangerous bear argument is the existential regulatory risk regarding payment for order flow, or PFOF.
Oh man, this is the elephant in the room for Robinhood.
Hmm.
For you listening, Robinhood famously offers commission-free trading, but they aren't a charity. They make the bulk of their money by routing your trades to massive market makers, like Citadel, who execute the trade and pay Robinhood a fraction of a cent for that order flow.
Right. Think of Robinhood's platform as a free highway for retail traders. Robinhood makes its money by selling billboard space and toll data to the market makers who operate the exits.
The SEC has been targeting this practice for years, arguing it creates an inherent conflict of interest. Regulators argue brokers might route your trade to the market maker who pays the highest kickback rather than the one offering you the best execution price.
And if the SEC suddenly shifts its regulatory crosshairs back to PFOF and mandates that trades must go to public exchanges rather than internal market makers, Robinhood's core revenue engine seizes up overnight.
It would be absolutely devastating.
It would. Combine that existential sword hanging over their heads with the psychological damage of the CEO and CFO dumping shares, and bears argue that retail investors are simply providing the exit liquidity for executives before the growth permanently stalls.
So, putting the bulls and the bears together, what does the actual timeline look like for this stock?
In the immediate short term, over the next few days and weeks, you should expect violent consolidation between $85 and $90.
It's just a waiting game to see who exhausts who first.
Exactly. If the buyers can push it through that heavy resistance at 90, TradingView analysts note a technical bull flag pattern on the chart. If that flag triggers, it could spark a rapid momentum breakout straight to the $100 psychological level.
And if it fails?
If it fails, the momentum dies, the options puts take over, and it risks sliding right back down to that $70 floor.
And if we look years down the road?
If we connect this to the bigger picture, the long-term survival of Hood depends entirely on shedding its image as a domestic casino app and maturing into a global financial powerhouse.
Right.
The long-term forecasts remain highly optimistic, assuming they successfully execute massive international expansion and maintain dominance in retail crypto infrastructure. Some models project the stock hitting $156.37 by the end of 2026, and looking out to 2030, forecasts push as high as $294.98.
Let me quickly recap this incredibly complex picture for you. You have a company posting a massive 52% jump in revenue, sitting on $4.3 billion in cash, and enjoying the absolute freedom of the SEC stripping away the $25,000 day trading rule.
All good things.
Right, but on the flip side, the stock is trapped below a highly bearish 200-day moving average. Analysts are violently split on whether it's deeply undervalued or a massive value trap, and its own executives are selling off tens of millions of dollars of stock right as it hits technical resistance.
It's a lot, Taiwei.
So what does this all mean? It means you are looking at extreme structural volatility. It's a battlefield between short-term momentum and long-term uncertainty.
Absolutely.
Before we wrap up, if you enjoyed this deep dive, please take a second to hit that subscribe button, like the video, and drop a comment below with your take. We really need those comments for the algorithm. Are you buying the breakout or are you avoiding the trap? And remember, everything we discussed today is purely an analysis of the data and sources. Absolutely no financial advice is being given here.
As you look at that data and decide where you stand, I'll leave you with a final thought to ponder. Now that retail traders are completely unleashed from the $25,000 day trading safeguard and borrowing money is potentially getting cheaper, are we witnessing the dawn of a truly structurally democratized market? Or has Robinhood just handed millions of retail traders the exact rope they need to hang themselves in the next market correction?